Okay, well, we'll start. Well, firstly, good morning, everyone. With this being our first webinar of the year, I'd like to wish you all everything the best for a happy and successful 2021, in particular following the challenges we all faced last year. On behalf of the Morningstar team, I'd like to welcome and thank you for attending this exclusive webinar. I know we have some new advice businesses starting to strategically partner with us. So for those of you I haven't met, my name is James Lowe and I lead our business initiatives in the financial advice sector. Firstly, how we strategically partner with successful financial advisors and practices and licensees who share our beliefs of absolute focus on client centricity in how they serve, placing the end investor's needs above all else. Secondly, the teams that partner with these advice businesses to provide our solutions and services in a manner that not only aligns to best practices that we see from advice firms around the globe, but importantly for what is unique and makes sense for your firm and advice process. So I know that the team's delighted that you can be here as we kickstart 2021 together. A big thank you to all of you on the positive feedback we received throughout 2020 following our regular forums, webinars, and digital initiatives with practices to ensure we not only maintained, but actually increased the opportunity for you to engage in a meaningful manner with our local and global thought leaders at Morningstar. We reacted and pivoted our service model in February 2020 to ramp up our digital and virtual interactions with you, to ensure you all have the support you need from our partner. Looking ahead from an in-person versus digital engagement perspective, we're going to have to continue to assess how best to achieve this result with the changing circumstances in front of us following the COVID pandemic. More detail that will come through in the coming weeks. Irrespective of the format in 2021, we will be further doubling down and providing you access to internal and external thought leaders in the three pillars of our partnership with advice businesses that we serve: investment solutions, behavioral coaching, and practice optimization. So before I introduce the speaker for today, I just a couple of housekeeping items, and Jody will flick through just the questions on the Q&A. There is a chat function at the bottom. Please do send these through, and we will monitor them on our side and make sure that either through the presentation or at the end, we'll endeavour to cover as many as we can. There'll also be CPD details, which will be sent to you following the webinar. And obviously, I will touch on the recordings and summaries that will pop through at the end. So when I looked at the advisors and practice principals who registered for today, I could see that you were all at different stages of your journey partnering with Morningstar. Some long-standing and some newly formed relationships who have only recently started to partner with us. However, while at different stages, the foundation of our partnership with you is about the application of that joint belief in following the same evidence-based investment principles in your practice and being like-minded in applying that valuation investment approach for the clients you serve. As a result, we thought it was pretty important to start the year's webinar series with the key foundational pillar in our partnership with you of investment solutions. In addition, we had a number of requests from advisors for a deeper dive into excellent investment insights raised by Global Chief Investment Officer Daniel Needham, following a presentation he delivered at the end of 2020. In this presentation, we discussed the evidence at hand, which suggested that there'd never been a better opportunity to implement a contrarian valuation investment approach for all client segments in advice businesses. With a number of the positions Daniel discussed paying off for your clients, we thought it is important to provide a further update. This is an important message for your clients that you serve, and also further endorsement for those of you who made the decision some time ago, and for those now embarking on transitioning to this valuation investment approach for your business. So with this in mind, I'd like to introduce you to Jody Fitzgerald. Jody is Head of Institutional Portfolio Management for Morningstar and a member of the leadership team in our business in APAC. Like me, Jody has a long history with our firm and with our roots in the business going back to the early 2000s, where we worked together with Daniel Needham and Chris Galloway. Jody leads investment specialists in the team that support the delivery of our investment solution pillar in our service offering to advice practices, in particular those advisors partnering with us that have either already or in the midst of transitioning the business to implementing a goals-based investment approach and aligning to their advice philosophy. So welcome, Jody. Just with an introduction, as advisors listening and Morningstar together follow this valuation investment approach as joint fiduciaries, an important starting point is probably to discuss the evidence surrounding the implementation of this approach that we implement. In addition, I know over the last couple of months, a number of the clients of advisors who follow this investment approach would have experienced reasonably strong performance. However, that hasn't always been the case over the longer timeframes of a year or so, has it?
No, it certainly hasn't. And thank you everybody for taking the time to be with us today. Performance is actually a really good place for us to start, given that people on the call with us today are at various stages of their journey. It's always good to just remind ourselves on our investment process and how that process is likely to behave during a cycle, so over the short, medium, and the long term. So the chart that I have here on the screen at the moment shows the performance history of our growth real return fund relative to its CPI plus 3.5%. This really is, I guess, our flagship offering in the marketplace from a fund's perspective. Over the long term, what you'll see is that we have delivered on that investment promise to clients, but it certainly hasn't been a straight line. We are a high conviction contrarian manager, which means our performance profile can actually be a little lumpy in nature, and particularly over short time frames. You'll see if you have a look at my cursor there on the screen that in the last quarter of last year, we experienced some really significant outperformance. And this was as some of the high conviction positions that we established through the COVID sell-off started to pay off. But basically what we know is that these positions can be a little uncomfortable when we're first establishing them. If you have a look at the 1-year return number, you can see that that is still in lagging from an objective perspective. The reason why I wanted to show you this performance over the longer term is to give you a reminder or an understanding that we've been here before. We've managed through periods like this once before, where actually in our process of establishing these high conviction contrarian positions, we will experience periods of uncomfortable performance. And you can see that has occurred back in 2010. I'll draw your attention there to the red box. So what were we doing back in 2010? Back in 2010, we went heavily underweight Australian shares. And in fact, we actually held more A-REITs than Australian shares. Now, you remember that this was coming out of the GFC. And A-REITs were horribly unloved, as most investors had really given up on them after 2008, 2009. We also went overweight Japan after Fukushima and before the arrow policy came into place. We also had a large currency position in place as the Australian dollar was starting to march towards $1.10. So for these reasons, as we were establishing these positions, if I go back to this chart, this period back here in, sorry, to keep my cursor in the right place, 2010, was as we're establishing these positions, they were still finding their low point. So we know that when we're putting in place these high conviction positions, there will be some uncomfortable performance in the short term. But over the long term, as that value is realised, it certainly makes up for any discomfort that may have been felt in shorter timeframes. This is really a simple visualisation of what we are looking to achieve in our investment process. So the orange line represents the fair value of an asset, and the reddish maroon line, I guess, is how price typically behaves around fair value. It oscillates around, it overshoots and undershoots through time. So in our investment process, as you will well know, that we are seeking to buy assets when they are less than their fair value. And as much as we'd like to buy it at their absolute low point, it's really difficult, if not virtually impossible, to actually do. So instead, in our process, we are looking to buy assets that are trading well below their fair value and to do so with a significant margin of safety. Ideally, where we typically pick up the assets is somewhere around this green line. So what happens is when we pick these assets up, we know that they're significantly below their fair value. So the probability of additional losses is actually quite low. So the gap between the green line and the bottom point is quite small, whereas the probability for potential for gains is actually at its highest. But in buying assets at this point, we know that there will be periods as the asset is actually finding its low point, but that will filter through into some of our short-term performance numbers. And that's what you've seen in our 1-year numbers. But obviously, when you look at that as the returns start paying off, as it did in the December quarter, the delivery of that return can actually be quite lumpy in nature.
Jody, I mean, one of the questions that I know we got a lot of, particularly towards the end of last year, and even in the first few weeks of 2021, we're getting the same questions, is really the value to growth divergence being so wide. And sort of number of the questions we're getting from advisors is value investing dead? Should they be reflecting on valuation investment approach in the business? What are your thoughts?
Yeah, it's actually a well-covered topic, really, also in the press and in various journals. Short answer, no. The cycle always exists. That's the one thing I'd remind people, is that the concept of it's different this time, it's never really different. It might be shades of different, but cycles will always exist. The market sell-off that we saw with related to the COVID has really provided us with a once-in-a-decade opportunity. The sell-off, though, was quite phenomenal in the sense that it was probably, well, it was the shortest sell-off we've actually seen in history. When you look at the S&P 500, the bear market only lasted 33 days. And even though on the surface it looks like markets are fully recovered, with most markets back at all-time highs, when you actually start to unpack and disaggregate the performance of the markets, you'll see that there's actually a lot of dispersion. There's dispersion between sectors, there's dispersion between countries. So some countries have done a lot better than others, some sectors have done a lot better than others. The biggest dispersion that we see actually at the moment, though, is between value and growth. So this chart actually shows you the performance of value versus growth, which is the blue line, and growth, which is the orange line, relative to the MSCI World Index, for as long as that index has actually been tracked. And as you can see, going back to my earlier point, the cycle always exists. There are times when value is in favour, times when growth is actually in favour. If I draw your attention to the right-hand side of this chart, though, you will note that the dispersion between value and growth has never actually been bigger since this index has actually been tracked. What we find is that value tends to perform poorly when there are concerns about economic growth. Now, if you think back to 2018, when this period of dispersion between value and growth really started to sort of pick up, back then the markets were actually anticipating the start of a recession. There were concerns about growth, things were starting to look a little bit lackluster. So the market was starting to price recessionary concerns in. As a result, any assets that could actually offer a growth profile were being significantly bid up in price. So growth started to outperform value. Now, the extent of that divergence, as you can see in this chart, took a huge leg up when the COVID sell-off actually hit. And it makes sense because during this time, the market started to significantly price in winners and losers from the coronavirus pandemic. Winners being anything that would allow us to work from home, anything that would allow us to do shopping from home, etc. The losers were any businesses that were cyclically tied to the economy. So things like energy, financials, etc. So these positions were significantly punished. And when you look back through history, what we know is that when value starts to actually stage a powerful and long-lasting rally is when the market anticipates the end of a recession or a pickup in economic growth. And that's actually indicated on this chart by the red arrows that you can actually see there. So is value dead? So if you think back, as Amanda, cast your mind back to 2018, the market was anticipating an economic slowdown, growth was outperforming. We now have the biggest dispersion we've ever seen, and the market, we're actually in the middle of probably an extremely deep recession, one of the deepest recessions we've ever seen. And the market is now starting to price in the potential for a recovery. And that's associated with sort of like a clearer outcome in the US with regards to sort of the presidential elections, the rollout of a vaccine, and the impact that the vaccine will have on allowing economies to open back up. So from a perspective of where we're at in the cycle, we actually think at this point in time, we are presented with really a once in a decade opportunity to really harvest returns from value style investing. And we would say at this point in the cycle, it's akin to, you know, buying low and selling high. So if you have clients that aren't currently invested, buying at these low prices or entering into a valuation driven portfolio is offering you an amazing sort of, you know, price and entry point at this point in time. Just to sort of reiterate, I guess, that performance of value versus growth, academically, there's a lot of research that supports that through a cycle, so over the very long term, value does tend to outperform growth. And this chart here shows you the performance of value versus growth, or the excess return of value versus growth, going back to the 1960s. And it uses the Pharma French database, which is actually available publicly. So you'll see that over 1 year periods, over that extremely long time frame, value tends to outperform by about 4% per annum, over 3 years by about 3.7%. In the year after you come out of a recession, though, you can see that those return profiles are significantly larger. So in the year following a recession, as economic growth starts to kick in and cyclical stocks start to get repriced, we see that value tends to outperform growth closer to 10% in value. So at the moment, we actually think that our portfolios are like a coiled spring. As the coronavirus sell-off occurred, leading into it, you'll recall us talking about the fact that we were quite concerned about market valuations. We thought that most assets were significantly overpriced. We had a lot of our portfolio actually sitting in cash. When the sell-off started to occur, it actually gave us the opportunity to deploy that cash, some of that cash, and buy assets at prices we hadn't seen for 10 and in some cases 20 years. So we've loaded into these positions. These positions are cyclical in nature, and hence why you're seeing that volatility in our shorter term performance. But what you'll see, and what I have here on the screen, is this shows you the factor exposure in our portfolios to value. So if you run the equity component of our portfolio through a factor analysis, this is telling you how much of that portfolio is factors return is coming from value. And what you can see, aligning with the COVID sell-off, we really ramped into valuation opportunities. And in fact, our conviction in value has actually never been higher during the entire sort of duration of our process. So we really do see this as an amazing time to be a value investor.
Jody, I mean, that sort of dispersion of the value and growth sort of gap is just incredible in terms of the size. And funnily enough, I remember in 2015 when I was working in an advice business, just how much at the time following an evaluation approach, just how advisors and clients were sort of asking questions. So with that sort of gap even being double that size now, it just makes it even wider. And as you say, a multi-decade opportunity. As you were talking earlier, I mean, one of the things that sort of jumped out to me was just on the incredible opportunity that exists is the famous Warren Buffett quote, which holds close to my heart, which investing is simple. It's just not easy. And probably hearing you speak and showing the evidence truly does make it seem so simple, I suppose. But however, as we know, to stay true to a valuation investment approach means being different at times, and that can be lonely, as Daniel often says. So as a result, it's not that easy, which is why we provide all our support tools to advisors we serve. For the advisors partnering with us who follow this valuation approach in their practices, put another way, where we've sort of, I mean, you've got it on the slide there, where we're fishing at the moment, where potentially others are not fishing.
Yeah, so I'm going to walk through a couple of examples. We have plenty that we can walk through, but I'll walk through two of the key examples that are flowing through all of our portfolios. And you're right, as a valuation manager, in contrarian manager, we get our opportunities and our ability to really generate wealth for our clients when everybody else hates the idea and has bid that asset down quite incredibly. So I'm going to kind of walk you through the framework, I guess, that plays out here in our team and at the desk when we're looking for new opportunities and how we come across them, how we delve into them and make a final decision about actually this is really a fantastic place to put the portfolios. So the first example I'm going to walk you through is actually energy, which is a rather compelling opportunity at the moment. It's actually one of the biggest positions that we have in our portfolio. We've liked energy for a while prior to the COVID sell-off, but the COVID sell-off actually provided us with an opportunity to significantly increase our position in this space. So what I have here on the chart is the top right-hand chart shows you the spread between the performance of the MSCI Energy Index and the MSCI World Index. And as you can see, that spread at its very low point was never wider. Now that's quite phenomenal. So we have actually had some really strong performance come through in energy over the last couple of months. Hence you can see that tick up, and I'll address that in a moment. But when you look at that low point, sort of around August, September-ish of last year, what's striking about that is that the COVID crisis really is cyclical. Oil went into, well, actually, oil price itself went into negative territory. Some of you may remember that futures contracts actually became negative in around May, which basically meant anybody holding a futures contract on oil was paying the oil company to take it back, which is phenomenal and insane. So what's really interesting is that the market started pricing energy companies lower during a cyclical moment in time than it did during structural issues within the industry. So if you cast your mind back to, and probably a really good example of when there were structural issues faced by the industry is back in sort of 2016. And that's when shale oil in the US really started to come online. And shale oil basically drove the price of oil down quite significantly. Now, a lot of the large integrated players had really lazy balance sheets. They were overcapitalized, and their break-even price to be able to generate a return for oil was very high. And in some instances, it was close to, if not over, $100 a barrel. So as oil prices drove down, it was virtually impossible for these companies to actually make a profit. Their ability to be profitable was completely decimated. And we entered into a structural phase where these companies had to completely restructure their businesses. Now, interestingly, when we have a look at this chart, energy companies were priced lower for the COVID sell-off than it was for that structural period. Now, the COVID sell-off, as I said before, is simply cyclical in nature. And it's, people have stopped traveling, we're not getting on airplanes as often, etc. But as a vaccine comes in and as economies open up, we know that that demand for oil will eventually be there. So the first thing that strikes us is that when you look at it relative to history, something doesn't feel quite right about the way the market was pricing energy.
Jody, sorry, just before you sort of jump into the next slide, it might be worthwhile, there's a question that's come through, and it might be just a time to sort of clarify. And one of the questions that came through on the chat was that just confused how prices are low, and that if sort of markets are overvalued at the moment. And I think what you're sort of touching on, it's probably less a case of markets being overvalued, but some being overvalued, and then finding opportunities in some that do exist. It might be worth us clarifying that sort of the broad statement of markets being overvalued versus finding opportunities.
Yeah, 100%. And I mentioned earlier that markets have gone back to all-time highs, but it's really important to look through the headline number. So from a headline perspective, it feels like everyone's made their money back. If we're in a coma for a year and woke up today, you'd think nothing happened, outside of the fact that you can't, you're socially distancing, but the markets are back to where they were. However, when you unpack that, you can see that there are certain parts of the market that have run really hard. So anything that was leveraged to doing well during the COVID sell-off, so US, IT, etc. There are other areas of the market that still haven't recovered at all from this coronavirus sell-off. So the dispersion between countries and between sectors is actually really wide at the moment. So there are more opportunities, even at these higher valuations, for us to get set in positions than there was probably 12 months ago. So it's quite phenomenal, the dispersion. And in fact, even with energy having a really fantastic run over the last 3 months, hence that performance profile for the Real Return Growth Fund for the 3-month period, it's still about 60% behind US IT, for example, for the 12-month period. So there's still a lot of ground to be made up. There's still a lot of return profile left.
Thanks, Jody. I think for all participants, feel free to either put questions in the chat or the Q&A, whatever you feel more comfortable with. Thanks.
Yeah, happy to make this really interactive and for everyone to get value out of it. So this chart is the one that makes you go, okay, something is going on here. It's quite a compelling chart. When you have a look at At this point in time, or when this chart was pulled together back sort of 15th of January, we're showing you the market cap of Apple, so the entire value of Apple as a business, versus the market cap of the entire MSCI world energy sector. So what you can see here is that Apple, one company, is worth more and significantly more than every energy company in the world. So you could go out and you could buy BP, Total, Chevron, Shell, all the, various companies like that, and still not have had enough money to have purchased Apple once. It just doesn't seem logical, okay? So from that perspective, we sit there and go, right, relative to history, it's being really, harshly priced. And the dispersion of its pricing relative to other aspects in the market also looks a little bit strange. So that's when we decide to really delve into an opportunity and say, there seems to be something happening here that's a mispricing opportunity, but we need to investigate that it truly is a mispricing opportunity.
Jody, I mean, one of the questions, it's not in the chat at the moment, but one of the things I know that the team do get from advisors is energy not a dying sector, a bit of a dinosaur sector, a lack of on the focus on renewables, etc. It might be worthwhile just clarifying.
Yeah, look, and ESG is becoming sort of, increasingly topical within investment environments and so forth. And that really is a question around, in a move to a low carbon world, is energy fairly priced because these businesses are not going to be relevant on a go forward basis? And I'll address that. But what I want to do is, because what we're talking about there is the demand side. I want to look at both aspects of it though, because when you're looking at any commodity, it's really important to understand the supply side and the demand side. So let's start with supply and we'll address the ESG or the low carbon issue when we get to demand. But when you look at the supply side, so this chart here shows you inventories of oil and then world demand and supply. What you'll actually see here, so focusing on the blue bars, is that leading into the coronavirus situation, you can see that we were actually running down inventories of oil. And that's predominantly because, over the last sort of 3 years, a lot of these businesses, a lot of the energy businesses have actually been cutting their exploration, their drilling, and a lot of the capex in those more traditional areas. So not surprisingly, in 2020, we've actually had a build up in inventory because people are simply not traveling. So the current supply is leading to a build up because it's not simply being used. However, once COVID-related demand recovers, and even if it doesn't actually recover, so if people don't go back to traveling the way we used to, there will be demand for oil. When that occurs, what you'll see is this, this glut will become a shortage extremely quickly. Now, what people sometimes forget is that supply side is actually really slow moving. So we can see that there's a supply side issue that is likely to occur here. However, the market is, as you say, partly ignoring that because there's this focus on, but we're moving to a low carbon world. So it doesn't matter if we don't have the supply. And the reality is it does. So yes, we're moving to a low carbon world. And, most economies are starting to commit to the idea of having, zero carbon emissions by 2050. And in fact, interestingly, a lot of the integrated global energy players are also committing to zero net emissions by 2050. So as a result, a lot of these major, and we'll focus on European energy because that's the example that I'm going to give you in a moment, a lot of these major European energy companies are actually at the moment dedicating 50% or more of their capex to low carbon activities. So the reality is, are these businesses dead? Well, if they don't evolve and become a part of the solution, yes, they're certainly going to have some concerns, but they know that. And actually what you'll find is that these businesses are likely to be a part of the solution as much as they've been a part of the problem in the past. So that spending on low carbon initiatives will be really important for them. That said, if we look at the demand side, what we know is that, so this actually shows you the demand for various sources of fuel. what we know is that from an OECD perspective, we're certainly going to see lower demand for oil per person, per head of population. But there's two elements here that need to be considered. One is that even though as a human being, I might actually demand slightly less fuel than I did 10 years ago, there are more human beings on the planet. So that in itself actually causes sort of a pickup in demand. And the chart here, the right-hand side of the chart, shows you that the vast majority of the demand for oil over the next sort of couple of decades is really going to come from developing nations. They're actually going to be an extraordinarily strong part of it. Even with the move to low carbon, the element that seems to actually be impacted the most is actually going to be coal, more so than at the expense of gas or oil. So when you sort of lay this out, you think, okay, so the market is pricing in that this thing is never going to grow again. It's basically saying it's worth less now than it was during structural problems back in sort of last decade. But we can still see that there's supply constraints and that there will be demand. So does that make sense? So this is where we say, okay, fundamentally, these businesses should be capable of generating cash flow revenue. So what should we value them at? What is the actual fair price? What I thought I'd do for you today, and it's probably not something that we've done a lot in the past, is actually unpack for you how we come up with broadly sort of the valuation that we've put on energy. And I'm going to use European energy as an example. You would have heard us in the past talk about the fact that the value of any asset is the cash flows that asset can generate and the growth of those cash flows. So I'm going to walk you through high level some of the cash flow assumptions and the growth of cash flow assumptions that we have for European energy. So the chart over here, what it shows you is that currently the cash flows of European energy is 6.8%. Cash flows basically, if we say what is the current dividend yield plus the buybacks. Now, buybacks are increasingly an important way that businesses return cash flow to investors. So it's the total payout ratio that we're looking at is a combination of dividends and buybacks. So currently that sits at 6.8. Granted, that's a little bit elevated because it's a yield. So the price is suppressed. So that number looks reasonably high. The long run average, if you look over the longer term, it's 5.3. Our current assumption is 4.4. So what we've actually done is you can see that we've made a conservative assumption that we think that the current payout of these companies needs to come down, and it needs to come down even further than the long run average. Now that's actually quite penalising because you need to remember that long run average actually includes that structural issue around shale, when these businesses for a number of years were not able to actually really generate profit and return as much cash to shareholders. So we're actually saying structurally going forward, they're going to actually be below that. So we've penalised them for the fact that we believe that they will need to cut dividends to sustain their balance sheet through this period if coronavirus is actually extended longer than anticipated. We've also assumed that they'll need to retain earnings to actually plough further into CapEx associated with renewables. So our cash flow assumption is fairly conservative relative to history and relative to where it is at the moment. We then think about, well, how can these cash flows grow? And what you'll actually see here is I've pulled out sort of the key metrics that we look at, which is ROE and margin. So basically the ability of these businesses to grow their cash flows predominantly depends on their ability to earn and their ability to earn margin on their earnings. So when you actually have a look at it here, currently the return on equity is only 1.3, which is basically really low. And that makes sense, right? Because there was concerns with regards to oil price falling into negative territory, demand shocks, and some supply concerns back at the beginning of 2020, where Russia decided not to play nicely with OPEC. So that's all well and truly priced in. Now, over the long run, the return on equity typically is about 14.3. We're assuming only 11. So again, we are assuming that the return on equity these businesses can earn is still going to be lower than that tough period experienced during the last decade where there was shale oil where shale oil just completely decimated earnings effectively. What I'd like to also point out is that our model assumes we don't need a huge oil price for these businesses to be making earnings. And our model is actually just assuming $50 a barrel. We're actually above that today already from the perspective. When we put the position on, well, we weren't that far away from where we needed it to be. So we're being quite conservative with regards to our view of where the oil price should be. And then margin. So the margin at the moment is extremely low, as you can see there from the chart. The long run average is 5.7. We're assuming that margins will come back roughly in line with long run averages, a little bit below. The reality is we expect that is quite a conservative assumption, because we know that these businesses had to restructure quite significantly when shale oil came on. So they are now in a much better position to manage earnings in a low oil price environment than what they were 10 years ago. Still, we're assuming that margin will be lower than what it was over that 10-year period. So what you can see here is that we're actually being quite conservative in the way that we're building our assumptions of what should energy actually be worth. We then come up with, and you would have heard us talk about before about our valuation implied returns, or our VIRs, as we often call them. What our VIRs are telling us is that what is the expected return of an asset over the next 10 years. So we believe that assets will mean revert to their fair value. We have a look at the dispersion of the asset relative to its fair value and assume that it just mean reverts in a lovely linear fashion over that 10-year period. So in this example, at the moment, we believe that the expected 10-year return is 8% for European energy per annum. Now, this is the real return, so add inflation on top of that, add currency as well. So I'm excluding the currency from this. You'll see on this chart here that expected return has actually come down, and that is because of the rally that we experienced in the fourth quarter of last year. Now, the reality is we always look at mean reversion over the 10-year periods, and we're fairly silent on when it will mean revert, because the reality is we don't know. Most assets won't mean revert in a nice smooth profile of the 10-year period, and we find that typically this mean reversion happens very lumpy and in very short periods of time. So that's why it's super important for us to be set in an asset with expectations that we're going to invest in it for a long term, but monitoring when that mean reversion actually occurs and then divesting at that time. So what I've actually done here in this table below is just to give you an understanding of the potential return expectation of this asset. So even including the rally that we've recently seen, if the asset was to mean revert over the next year to what we see as fair value, the potential return expectation is in the order of close to 63%. Again, add currency, add inflation on top. Over 2 years, it's close to 30% per annum. So as you can see, this is why we have a high conviction in this particular asset. Conservative assumptions, it's being underpriced, and some valuation looks a little odd relative to how the market's valuing other assets.
Jody, sorry, Jody, just before you, a question came through earlier, and I thought I'd wait for the section to sort of answer it, and I was going to sort of jump in a slide or two ago. I think now's a good time. You've really just unpacked very articulately how we do our valuation investment approach as it related to the energy sector. One of the questions that's come through is, you're not suggesting that Morningstar is a value investor. That's question one. And question two, you are, however, seeing opportunity in value at the moment. It might be worthwhile just clarifying just the valuation investment approach that we followed, which you've now gone into detail, but just at a very high level, and then just the opportunity aspect that you make. I think energy is obviously an opportunity, but it's not necessarily. There's obviously, as we said earlier, a lot of other areas that are particularly overvalued.
Yeah, absolutely. So that the first question was that we're not a value?
Yeah, I just want to suggest Morningstar is not a value, and I obviously know the answer. We're certainly a contrarian valuation investment approach we follow. So we are. So,
no, I think, sorry, James, to cut you off.
No, go for it.
I think that there's an interesting distinction, and it sounds subtle, but it's actually, sort of reasonably important to understand, is that we are a valuation-driven asset allocator. So we will only hold an asset if we think that asset is priced below fair value. We sometimes will hold assets in a portfolio because it's offering us risk diversification. So that's an important part as well. That is slightly distinct from being just a value manager where you buy something because it's got a low PE. So there is a subtle difference. So for us, we need to believe that the value of the cash flows are being undervalued by the market, not simply that the asset is priced lowly relative to everything else in the market. If we can't find assets whose cash flows are being mispriced, we will tend to hold cash, which is why leading into the COVID sell-off, we had elevated levels of cash in the portfolio. Now that was actually extremely advantageous for us because when we started to see these assets sell off, and as I said, we were picking up some of these stocks at 2003 prices. It was, it was crazy. We had the cash to deploy. Whereas people who might follow a strict value approach need to stay fully invested at all times. So what they'll be doing is looking for the cheapest things available in the market. So it's a slight distinction, and it may not sound like a big distinction, but it is. And if I, at the risk of losing our spot in the presentation, if we come back to here, you can see that there are times where it looks like we're biased away from value. What you'll find is that these are times where we're simply holding elevated cash and where, our other holdings in the portfolio are more there for risk management and diversification benefits. So we are very much, valuation driven and contrarian. I hope that clears it up. If it doesn't, please reach out, and I'm happy to have a conversation with you.
I think you answered it well, so that's great.
So I wanted to just give you an example to bring it to life, because I know when you're talking to clients, people latch onto stories, and real life examples are a hell of a lot better than they actually do So basically, one of the positions that your clients will be exposed to through this energy position in the portfolio is BP. Everyone knows who BP is. It's a big integrated global energy company with businesses across exploration, refinery, delivery of products and services. Now, it strategically had to make a big shift, okay, when we had shale oil come. And what you'll see is that whole structural moving of the way that it actually deployed CapEx, the way it managed its balance sheet. If you go back to just where my cursor is, sort of back to, early, sort of 2011, 2012, the break-even oil price BP required, so the break-even oil price is basically the price required to cover its CapEx and its dividends, was well and truly above $100 a barrel. We're talking more like 150. The light blue line is the other large integrated energy players in Europe, and as you can see, they were significantly high as well. They were forced over the period of the last decade to significantly restructure. So what you can see now is that BP's break-even oil price is, around $20 a barrel. Today, energy is well above 50, above that assumption that we've got in our model. You can see that the other European players, their break-even oil price is around 40. So what's really interesting, if you go back to that example that I gave you earlier about Apple and the market cap of Apple versus the market cap of the entire global energy sector, at the moment, Apple is actually, the implied growth rate in the share price is basically that Apple will need to grow by 6.4 BP. So take BP as a business, regenerate that business 6.5 times every year into perpetuity to justify the share price. So we're not saying Apple's a bad company. I actually think it's quite a good company and so forth. But what's priced in is perfection. BP, on the other hand, has an implied growth rate of 0, which doesn't make sense. This business can survive in a low oil price. They have actually been dedicating a significant portion of their CapEx to low carbon initiatives and have committed to being a zero emitter by 2050. So as you can see, when you start to sort of look through this story of energy looks cheap relative to history, fundamentally supply and demand is still going to be in place for at least the next 10 years, potentially even further, and that there's some really good companies that are well-run, well-structured businesses that should be able to deliver decent returns. To give you an understanding of how we've performed, because obviously energy has done reasonably well, particularly in the December quarter. What you'll see here is the red line is the price of BP through time. The green shaded areas is where we were adding to the portfolio. So we actually held BP and liked it sort of prior to the sell-off. But when the coronavirus sell-off kicked in, we significantly upped our weight in the portfolio. We found another opportunity to continue to add as the price continued to fall towards the latter half of 2020. So since November, since about 6th of November, the stock has actually risen about 50% from its lows. So we've made some really good money from it, but we still see significant upside. Here in this table at the bottom, I've actually pulled in the Morningstar equity research. So our friends at the other side of the floor who do fundamental valuations. And we've looked at, well, what's the, the current price, and this is current as at the 15th of January, current price versus the bear, bull, and base case. Now, the uplift in performance that we had from November has certainly seen us shoot through the bear case. The base case, though, still, from their perspective, has 79% upside, and the bull case has close to 150% upside. And when we actually look across other brokers in the industry, we can see that, quite often we find that Morningstar Equity Research are more conservative as well in their valuation. So that's just sort of a story that you'll be able to sort of discuss with your clients and give them a better understanding of why we're holding these positions. I'm conscious of time, James. I do have another example I can run through. But
yeah, I think run through it quickly. I think be worthwhile. Yeah, there's some. I mean, there's a couple of questions that have come through, so it'd be great to be able to sort of give ourselves enough time to answer those.
Okay. All right. So I'll briefly touch on another example that we actually have, which is UK. It's a really interesting story at the moment. So what I'm showing you here is the performance of the UK versus the MSCI over time. And as you can see, the only other time the UK was lower was back in the 70s. Now, let's think about what was happening back there. So back in the 70s, what we basically saw, there was the 72, 74 stock market crash where the market fell by 73%. So it was huge. During that time, we're talking about a property bubble, a banking crisis, oil price shock, falling pound, and huge industrial unrest. So some really big problems. The problems the UK is facing today is basically COVID, which the entire world's facing, and Brexit. We actually see both of these headwinds as being more cyclical in nature rather than structural. And when you compare them to the problems that the UK was experiencing back in the 70s, they're nowhere near as large. So again, the fact that the UK is at its second lowest point in history suggests that it's quite cheap. Brexit is probably the one that is sort of important to unpack. So we're kind of, we're through and we're at the other side. It's all happening at the moment. But the question then becomes, how does it impact the economy over the medium term? What this slide shows you is actually UK listed companies and having a look through at where they actually generate their revenue from. And what you'll see is that actually for UK listed companies, most of their revenue is actually generated from the US. And this is because we're talking about global companies. Most of the UK is actually dominated by quite cyclical companies, so energy, financials, and some sort of consumer discretionary type stocks. Outside of that, the UK itself, so the performance of the domestic economy is only really going to impact about 22% of revenues that's actually earned from listed stocks. So what's super important here is to actually separate UK as a country and the economic impact that may occur versus the impact it could have on the revenue of listed companies. When we have a look at UK, what this chart is showing you is a normalised PE ratio. You can see that UK is currently cheap. It's trading below its fair value. So the UK is the green line, but it's also significantly below its other European counterparts and is well below the US. If we actually go back through time, so if you go back to sort of, the early early 2009 and so forth, what you tend to find is that those three economies, that their markets tend to behave quite similarly. You can see that that dispersion has increased quite significantly over the last 10 years or so. So again, we feel that the market's taken a cyclical concern and overpriced it and priced it into perpetuity. In our modelling, we actually have assumed that the UK goes into recession. We've also assumed that a lot of these businesses need to cut their dividends, so their payout ratio, or that cash flow generation. We've made some substantial adjustments to that. But even so, we still find that there's significant value in the UK. If we look at the profitability from the profitability perspective, the return on equities in the UK is currently lower than it was coming out of the GFC. Now, again, if you think about that, it really doesn't make sense, because coming out of the GFC, you know, we had, and particularly given a lot of the benchmark is actually made up of financial businesses, these businesses had really bad balance sheet issues. They had some major overhauling that they needed to actually do. Today, the quality of the balance sheets of the major UK businesses is so much better than what they were during the GFC, but the market's pricing in a return on equity significantly lower. So if we simply see return on equity come back to that long run average, so at the moment it's around 9, if it comes back to closer to sort of 12%, it's going to be a 36% improvement. So on a forward-looking basis, we think that the market is sort of overplaying the impact that Brexit will actually have on the earnings of these businesses. So again, just to kind of run through, I guess, our valuation model, I'm showing you the VIR, and there has been some performance improvement over the last couple of months. At the moment, the real expected return for the UK is 5.7. So that excludes currency, and we actually think the pound, we've gotten some decent returns out of the pound as well, and also inflation. And the chart on that, the table at the bottom right shows you the same information I showed you for energy. And as you can see, once again, we've made assumptions that are more conservative than the market from a cash flow perspective. So we've assumed that the payout ratios are going to be a lot lower than what they have been historically and what they currently are. From a return on equity, we're simply assuming, our current assumption is that the return on equity is where it will be. We've assumed no improvement. We have assumed an improvement in margins, though, of these businesses, predominantly because their balance sheets are much stronger. They're more low-cost businesses than what they've actually been for a while.
Jody, it might be worthwhile if we pause there, and I know that the team serving advisors can sort of give a detailed rundown on the stock examples like the Lloyds you've got here, and we just move to questions. One of the sort of Q&As has come through, and not surprisingly, there was that sort of dramatic Apple sort of versus the energy sector graph.
My favourite chart.
How can Apple and others maintain or fulfill its implied growth expectations? So not that it's a crystal.
And that's why, and that is exactly why we are not, there is some Apple in some of the exposures in the portfolio, so some of the underlying managers, but it's why we're not overweight US tech. We think it's priced to perfection and beyond. Now, the challenge for businesses like that is that the way that they've made a lot of money, whether it's Apple or Amazon and so forth, is there's been a lot of consolidation. They're going out, they're buying other businesses, they're bringing them in. Apple, it's all about their hardware, the selling of the phones and so forth. We find it is going to be extremely difficult for them to maintain that growth rate. That's not to say that they won't grow at all, but the market is pricing in growth rate that just does not make sense. So for us, that's the type of volatility. I talked before about the fact that our return profile is a little bit volatile at the moment. Of course, we're in cyclical positions that will move around with the view of where we're at from an economic recovery perspective. However, we're in cyclical positions that are trading below fair value with a margin of safety. We don't want to buy positions like the US tech, where we know they're priced for perfection, because what happens is that that's where you end up with a permanent impairment of capital. If the market at some point realizes that the ability of Apple to continue to grow, or the change in growth, which is what the market's rewarding at the moment, is not what it was historically, that stock will lag. Doesn't mean it will necessarily, have significant underperformance or fall in price, but it will lag. What we're really talking about here on a go-forward basis, and why we're quite excited about our portfolio, is what's going to be rewarded, we feel, over sort of the coming 12, 18 months as the economy picks up and we start to see growth, is the delta in growth. Okay, so the change in growth or earnings growth of these businesses. Now, for Apple to get a change in earnings growth relative to what's being priced in, it's just so hard to see that. Whereas there are very low expectations for UK companies, for energy companies, for other financials in the US and so forth, that a small change in their earnings will actually result in a really large re-rating of the value of that stock. But, it's a good question, and it's 100% why we are underweight US tech at this point in time.
Got a one sort of final question, which is a great one. Obviously, from a strong believer in a valuation investment approach, the question was, or contrarian one, shall I say, why not use more cash to get more sizable bets when there are very high convictions? So obviously, we deploy cash from the portfolio, we keep it there for these sort of opportunities. Why not deploy more?
Yeah, it's a really good question, and it's a question that we are reflecting on ourselves at the moment. So obviously we built up quite a bit of cash coming into the sell-off and started to deploy it. And we probably had done some self-reflection and said we probably should have gone a bit harder. We probably should have deployed more cash during that period. But the element that we were worried about was the drawdown risk. As you know, we often talk about it's important not to have significant drawdowns, because that then impacts your ability to generate wealth on a go-forward basis. So the drawdown risk in the market was what was making us concerned about deploying more. But we are reflecting on that at the moment. We're reflecting on what were the signals that we looked at, and did we go hard enough? Should we have gone harder? What stopped us from actually taking larger positions? So it's 100% the right question to ask, and it's the question we're actually asking ourselves at the moment.
Thanks, Jody. And so, look, there are a couple of other questions. I must certainly ensure that the team that sort of serves advisors and practices will get in touch to address those and answer them. But thanks, Jody, that was great. And I'll just conclude the webinar now. Look, I think we have a number of practice principals and advisors on the call for whom this is the first introduction to our webinar series after recently making that decision to partner with us. So as a result, I thought it might be valuable just for a quick minute or two, just to provide a brief background, which might be a bit of a refresher for the longer standing partners with which you work on the foundation of this webinar series. They really go back to 2019 when we listened to all the advisors that were partnering with us, who sort of gave us the feedback they were looking for more information with a pure objective to how they can better support the resilience of their advice to their clients to stay the course of the quality strategies that they've put in place for them when faced with market uncertainty, such as what Jody mentioned today. For us, we see the biggest disaster would be a situation where you implement a quality financial plan and advice approach with your clients, and then they don't stay the course of the strategy when faced with investment uncertainty. So think of this webinar as the detailed perspective and understanding of Morningstar to an advisor positioning. In addition to that, advisors ask us for more content, digital video content, to help you engage with your clients to better support your investment approach you're implementing on their behalf. In other words, advisor to end client collateral. In particular, focusing on the evidence-based content to advise to you to support your messaging and communication to your clients. And really that's what Jody sort of went into a lot of detail on today. That continues today and remains the purpose to how we support your client engagement and existing conversations you have with my team. This doesn't serve to replace those, but rather support those conversations that you're having. So as a result, what you're going to be receiving from us today is collateral of slides that you can put into your own brand with scripts and speakers notes to help your client engagement, summarizing the themes of what you heard today. for you to use in review meetings with your clients, or even putting together your own short videos to share with them at scale. There will also be key messages and themes that Jody covered today in a form of a three to sort of 4-minute video from a Morningstar perspective that you can also share in your clients if producing your own videos is not what you currently do for your business. So just a summary of what you heard from Jody today, really evidence of why a contrarian valuation investment approach works for your clients and does deliver the outcomes advisors are striving to achieve. Secondly, evidence that Morningstar actually does implement that approach. And I know one would think that's taken for granted in the industry, but a key criteria for anyone looking to partner with anyone, with someone on investments is, do they do what they say they will do? And hopefully that came through strongly today. Lastly, if that is the investment approach that you do follow, has it been implemented on behalf of your clients? What is the experience they had during this time? In particular, give you the content relating to that client experience. So what you heard today was a real focus on the energy sector story and industry that you can share with your clients. Secondly, the BP stock story. And thirdly, the regional aspect of the UK. As I mentioned earlier, Jody does lead the portfolio specialists at Morningstar. So you can look forward to seeing a lot more of Jody in field with advisors, together with my team who serve the advice practices. I know they're looking forward to engaging with you on today's presentation and more of how we can work with you closer as a trusted business partner in 2021. So with that, thanks so much for your time. We have gone a minute over. I do apologize for that, but have a wonderful day, and we look forward to seeing you again soon for the next webinar. Take care.